Here's something strange. The single best investing decision most people will ever make is also the most boring one. It's not picking the right stock. It's not timing the market. It's buying a fund that owns a little bit of almost every big company at once and then doing basically nothing for 30 years. That's it. That's the secret that beats most professional money managers. Before we go further, quick note. This video is for general education, not financial advice. I'm not going to tell you what to buy. I'm going to explain how index funds actually work in plain English, so you can make your own decisions with real understanding instead of guesswork. So let's start from zero, like you're 5 years old, because honestly, that's the best way to actually get this. Imagine a giant fruit basket. Instead of trying to guess which single fruit's going to be the tastiest one this year, you just buy one of every fruit in the store. Apples, oranges, bananas, mangoes, all of it in one basket. Some fruits will go bad. A few will be amazing. Most will be just okay. But on average, across the whole basket, you come out ahead because you didn't have to guess right. You just had to own everything. An index fund is that fruit basket, but for stocks. Instead of picking one company and hoping it's the next big winner, an index fund buys tiny slices of hundreds or even thousands of companies at once. The most famous one tracks something called the S&P 500, which is just a list of 500 of the largest publicly traded companies in the United States. When you buy one share of an S&P 500 index fund, you instantly own a tiny piece of companies like Apple, Microsoft, Amazon, and hundreds of others, all in a single purchase. Here's the part that surprises people. You'd think that professional stock pickers who do this for a living and have teams of analysts most of us will never match would easily beat a simple basket of everything approach. And yet, decade after decade, the data shows something different. Roughly 80 to 90% of actively managed stock funds fail to beat their index over a 10 to 15-year period. Not because the fund managers are bad at their jobs. It's because beating the market consistently is just extraordinarily hard, and the fees those funds charge quietly eat away at whatever edge they might have had. Let's talk about fees for a second, because this is where a lot of the real damage happens. Quietly in the background, where you can't see it day to day. An actively managed mutual fund might charge you around 1% a year. An index fund tracking the same market might charge you around 0.03%. That sounds like a tiny difference. It is not. Say you invest $100,000 and it grows at 7% a year before fees over 30 years. With a 0.03% fee, you end up with a little over $750,000. With a 1% fee, that same investment grows to somewhere around $570,000. That 1% difference in fees costs you close to $200,000 over 30 years. Same starting amount, same market return, wildly different outcome, purely because of what you paid to get there. Fees are one of the few things in investing you can actually control, and that's exactly why index funds became so popular. Now let's bust a couple of myths, because index funds get misunderstood a lot. Myth number one, people think index funds are risky because they own so many companies at once. In reality, owning many companies is what reduces a specific kind of risk. If you buy one single stock and that company has a scandal or a bad quarter, your investment can crater. If you own 500 companies, one company having a terrible year barely moves the needle. That said, and this matters, index funds still go up and down with the overall market. In 2008, the S&P 500 dropped nearly 37% in a single year. In early 2020, it fell about 34% in just a few weeks. Index funds reduce the risk of picking a bad individual company. They do not protect you from the market itself falling. That's a real risk, and anyone telling you index investing is safe in an absolute sense isn't being fully honest with you. Myth number two, people think index funds are only for beginners. The training wheels version of real investing you graduate away from once you know more. Some of the most sophisticated investors in the world, people managing billions of dollars, use index funds as the core of their own personal portfolios. Warren Buffett, one of the most successful stock pickers in history, has said publicly that he's instructed a large chunk of his own estate be put into a low-cost S&P 500 index fund for his family after he's gone. If the guy famous for picking individual stocks wants his own family in an index fund, That tells you something about how the pros actually think about this for their personal money. Myth number 3, people assume index funds mean you can't lose money or that they're some kind of guaranteed win. There are no guarantees here. Markets can have a bad decade. Japan's major stock index took over 30 years to get back to its 1989 peak. That's an extreme example, and the US market has a very different history, but it's a real reminder that the market always goes up eventually is a pattern, not a promise. So how does someone actually use this information? Let's walk through a simple, realistic example. Say a 30-year-old starts putting $300 a month into a broad index fund. Not a huge number, just consistent. History suggests U.S. stock markets have returned somewhere around 7 to 10% a year on average over long periods, though of course that includes some brutal years mixed in with some great ones, and past performance never guarantees future results. Using a conservative 7% average annual return, $300 a month for 35 years, until age 65, grows to somewhere in the neighborhood of $540,000. The person only put in about $126,000 of their own money over those 35 years. The rest, over $400,000, came from growth compounding on itself year after year, mostly in the later years when the balance got large. That's the quiet engine underneath index investing. It's not about being clever, it's about being consistent and letting time do the heavy lifting. And this doesn't require a big starting sum either. Many brokerages today let you open an account with no minimum and buy fractional shares, so the habit matters more than the size of the first check. Let's also be honest about the trade-offs, because no strategy is free of downsides. Index funds will never make you rich quick. You are not going to 10x your money in a year buying the S&P 500. If someone's promising that kind of return with low risk, that's a red flag, not an opportunity. Index funds also mean you'll never beat the market, because you basically are the market. You give up the chance at outsized, stock picker-style gains in exchange for lower fees, less stress, and historically strong odds of a solid outcome over long stretches of time. For a lot of people, especially people who don't want investing to be a second job, that trade makes a lot of sense. For people who genuinely enjoy researching individual companies and understand they're taking on more risk to try to beat the average, that's a different, more active path. And it's not wrong, it's just a different set of trade-offs. One more practical thing worth knowing, index funds come in a couple of common flavors. There are index mutual funds and there are ETFs, exchange-traded funds. Functionally, they're very similar. Both are baskets that track an index. ETFs trade throughout the day like a stock, while mutual funds settle once a day after the market closes. For most long-term investors, the difference is minor. What matters more is the fee, officially called the expense ratio, and making sure it's genuinely low, ideally under 0.1% for a broad market fund. It's also worth knowing the S&P 500 is just one flavor of index. There are funds tracking the total U.S. market, international markets, and bonds, and a lot of long-term investors mix several of these together rather than holding just one. So let's bring this all the way back to the fruit basket. An index fund is a simple idea. Instead of guessing which single company will win, you own a small piece of hundreds of them at once. That spreads out your risk from any one company failing. It historically outperforms most actively managed funds once fees are factored in. It still rises and falls with the broader market, sometimes sharply, so it's not risk-free. And its real power shows up over long stretches of time, fueled less by clever timing and more by consistency and patience. If this helped make index funds click for you, consider subscribing, because next week we're digging into something that connects directly to everything we just covered. Why compound interest feels like nothing is happening for years, and then suddenly everything happens at once. It's one of the most misunderstood ideas in personal finance. And once you see it clearly, it changes how you think about starting early. This video is for general education only and is not financial advice.